I'm Craig Popp with Accrue Wealth, and this is Charts That Matter. What a month April was. To begin the month, the S&P 500 experienced one of the sharpest three-day drawdowns at almost 15%. This was followed by a robust 10% one-day rally on news that President Trump would pause tariffs. Since then, the market has attempted to digest the potential economic and inflation risk from higher tariffs, leading to further back-and-forth volatility. Investors are caught in a tug-of-war between the fact that this drawdown is largely self-inflicted and could be reversed quickly versus the risk that the White House digs its heels in and continues the trade war, with the potential for additional sector-specific tariffs. At the end of April, the market has recovered over 60% from the low set on the 8th. April became just the 8th month since 1978 to feature a 10+% decline, followed by a 10+% rally, all within the same month. The large swing in volatility is indicative of heavy selling, followed by buyers stepping in with conviction. The S&P 500 has exhibited a strong bounce rally on tariff trade relief headlines. The index is now coming against overhead resistance in the 5,600 to 5,745 range. Another key technical level we should continue to watch is the 200-week moving average. Over the past 15 years, this has served as a reliable support level. While the pandemic sell-off undercut this average, most other drawdowns have found support at or near this level. Currently, the 200-week moving average is upward sloping at 46.91. An interesting observation is that during the third week of April, a breadth thrust occurred, an infrequent but historically bullish signal. The calculation applies a 10-day average to the percentage of advancing stocks out of the total. When this metric rises from below 0.4 to above 0.615 within a 10-day window, a trigger is generated. While no single indicator should be relied upon in isolation, the vertical lines in the chart highlight that these signals often mark timely accumulation periods. Finally, while it appears for now that we may be past the peak of trade policy uncertainty, timing the market bottom is very difficult. If volatility picks back up, refrain from panic selling, getting out of the market now and buying once again when the outcome is clearer. Market sentiment can shift quickly. Historically, average gains of roughly 16 to 22% in the first 30 to 60 days respectively from recessionary bear market bottoms and 13 to 17% in non-recessionary bear markets have been observed. Thus, I recommend time in the market over trying to time the market, as the odds of timing it just right are extremely low, given that bear markets often bottom when the news is still troubling. Mixed messages on tariffs and trade talks will likely prevent the market from a swift rally back to new highs without a drastic shift in the perception of tariffs. However, a lot of negativity was discounted at the lows seen during the pullback, and there has been buying conviction coming off those lows. While it appears for now that we may be past the peak of trade uncertainty, timing the market bottom is very difficult.